Hi, Chris Maloof with Cross Country Mortgage here. I thought I'd do a quick educational video on mortgage qualification. How do we qualify for a mortgage loan? Don't teach a lot of these things in our school system, so I thought I'd try and bridge that gap a little bit and go through some of the variables that feed into that. There's a lot of things that feed into qualifying for a mortgage. I'm going to go through three of the primary ones today, but the mortgage industry is all about spreading risk. You know, how risky is a loan to a lender on one particular loan over millions of loans and over trillions of dollars. It's all about spreading risk. The less risk the lender's taking on, the lower the cost of that loan. So the three primary variables that feed into qualifying for a mortgage. Number one is your LTV, or your loan to value. The mortgage industry is littered with acronyms, okay? So your LTV, your loan to value. And that is calculated by taking the amount of the loan divided by the property value. How much are we borrowing against how much is the property worth? Now, how is the property value determined? Typically through an appraisal. You know, an appraisal will come out and say, based on comparable properties, the condition of the property, and a number of different things feed into it, this is the appraisal value of the property. And then again, we simply divide how much are we trying to borrow against that, and it gives us a percentage. And the lower the percentage, that's less risk for the lender. You know, if someone were to go into foreclosure and a lender had to sell that property, would they be able to cover that mortgage, that debt on it? So the lower the loan to value, the LTV number, that's less risk for the lender. So we want a low LTV number. Now, if we keep our loan to value, that percentage at 80% or less, we do not pay what's called PMI, and that's mortgage insurance. And mortgage insurance is something that is paid by the borrower, by you, the person on the mortgage, to make the mortgage payments in the event you were to lose your job. So that doesn't necessarily mean you're not going to lose your house. That just means the lender is going to get paid. That's private mortgage insurance, okay? And it can be pricey. It could be hundreds of bucks each month, so that adds up. So if we keep our loan to value at 80% or less, we do not have to pay that PMI, okay? Now, the second big variable that feeds into qualifying for a mortgage loan is your DTI, and that is your debt to income. And that's simply how much debt, how much monthly obligation in regards to debt do you have on your books as a percentage of your income. So that would include, you know, mortgage payment, car loans, student loans, credit card debt, any consumer debt is included in that number. And then we simply divide it by your income. If you're a W-2 employee, that's divided by your gross income. And again, that gives us a percentage. Now, the ideal situation is to keep your debt to income at 43% or less, because again, this is all about spreading risk for a lender. If you have a low debt to income, that means you don't have a lot of debt on your books, so the money that's coming into your monthly budget can be used to pay the mortgage payment. If you're carrying a lot of debt and you have a lot or high DTI number, that's more risk for the lender. So the ideal situation is to keep that DTI number at 43% or less, and the lower the better. Now, there are some programs out there that can go up to a 50% DTI. Now, that again affects the price of the loan. The more risk that the lender is taking on, that's going to make that loan more expensive. So we want to try and get our DTI number low. Now, the third big variable that feeds into qualifying for a loan is your FICO score, most commonly known as your credit score. There are three primary reporting agencies out there, and they keep track of how have you paid your debts over time, have you ever been late on a payment, have you ever filed a bankruptcy, how much access to credit do you have, what type of credit is that, how many credit applications have you put in a specific amount of time. All those things feed in to your credit report, and then your credit score is calculated off of that. And that's a range. There's a range between 300 and 850, with 850 being the highest. Now, we want to try and get our credit score as high as we can, because a high credit score means you've done a good job paying your bills over time. You don't have a lot of outstanding debt, never filed a bankruptcy, etc. So we want that FICO score to be as high as we can get it. And I would encourage you to watch the video I did not too long ago on a free resource. You can go out, you have the ability to order your credit reports annually free of charge. And you can go through your credit reports. If there's any information on there that's incorrect, if there is an old item on there that can be cleared off, you have the ability to dispute those things and maybe clean up your credit report a little bit and raise that credit score up. So I would encourage you to watch that video too. Now, there are also what are called break points on some of these things. So if we go back to our loan to value, if our loan to value goes down 75%, 70%, 65%, etc., the lower the loan to value, that's a break point. Once we hit one of those break points, the cost of that loan again gets less expensive. Same thing with a FICO score. If you have a 680 FICO score and you're able to get that up to a 720 FICO score, that has a dramatic impact on the cost of your loan. I mean, it could be upwards of thousands of dollars in terms of the cost of the loan. So we want to try and get that FICO score as high as we can. So a low loan to value, a loan debt to income ratio, and a high FICO score. Those are three primary variables that feed into qualifying for a mortgage. There's a lot of things that feed into the loan process, but those are the three big ones. So I would encourage you to hit the subscribe button, hit the notification button. Going to be doing a lot more educational videos on finance, on mortgages, etc. Hope this was helpful. I would encourage you to check out our website. We've got good information on our resource center as well as on our blog too. So have a good one.